Welcome to our exploration of the fascinating world of the behavioral investor. Have you ever wondered why we make certain financial decisions, even when they may not be in our best interest? It all comes down to our behaviors and emotions. Today, we're diving into the fascinating world of behavioral finance. Let's explore how our minds can be both our greatest asset and our biggest obstacle when it comes to investing. Chapter 1, aptly titled You Are Not Crazy, kicks off by reminding us that the market is, above all, a reflection of human behavior. But here's the twist. It's not just any behavior. It's often irrational, emotional, and unpredictable. Imagine the stock market as a bustling crowd. Some people are shouting in excitement, others are whispering in fear, and a few are just watching with a cautious eye. This chaotic scene isn't random. It's driven by deeply ingrained psychological patterns. Understanding these patterns can be the key to better investing. The most important thing you can do as an investor is to know yourself. Why do we make irrational decisions? It's all about survival instincts, folks. Our brains are wired to avoid pain and seek pleasure. For example, during the 2008 financial crisis, many investors sold their stocks in a panic, fearing further losses. This resulted in massive sell-offs and even lower prices. On the flip side, during the tech boom of the late 1990s, investors were buying tech stocks at astronomical prices, driven by greed and the fear of missing out. Another classic example is the housing bubble in the early 2000s. People believed house prices would always go up, so they kept buying, even when prices were unsustainable. When the bubble burst, it led to significant financial losses for many. Recognizing these biases is the first step to mastering them. Moving into Chapter 2, How the Brain Sabotages Investing, we delve deeper into the mechanics of our mental missteps. Here, we explore the concept of behavioral risk, which is essentially the risk of letting our own biases and emotions dictate our financial decisions. Let's talk about some of these biases. Ever heard of loss aversion? It's the tendency to feel the pain of losses more acutely than the pleasure of gains. Imagine you invest $1,000 in a stock, and it drops to $800. The emotional pain you feel from that $200 loss is much greater than the joy you would feel if the stock had gone up to $1,200. This bias can make us overly conservative, preventing us from taking necessary risks. Then there's confirmation bias, our tendency to seek out information that supports our existing beliefs and ignore what contradicts them. For example, if you believe a particular stock is a great investment, you might only pay attention to positive news about that company and disregard any negative reports. In investing, this can lead us to cling to poor-performing stocks, hoping against hope for a turnaround. Another common pitfall is overconfidence, which can be a dangerous friend. It's the belief that we know more than we actually do. Consider the case of day traders who believe they can consistently outsmart the market. Often, they trade excessively, incurring high transaction costs and taxes, which eat into their returns. Studies have shown that overconfident investors tend to underperform compared to those who trade less frequently. But don't worry, there are solutions. Strategies like automation can help us stick to a plan. For instance, setting up automatic investments into a diversified portfolio can help avoid the pitfalls of emotional decision-making. Additionally, having a financial advisor can be invaluable, not just for their expertise, but for their role as an emotional buffer. Think of them as a coach who helps keep you on track, especially when you're tempted to make impulsive decisions. Stay tuned, because in our next episode, we'll continue our journey through the fascinating world of behavioral finance, uncovering more ways to harness the power of psychology in your investing. Remember, understanding yourself is the first step to mastering the market.